Welcome back to the Deep Dive. This is where we take all sorts of sources, articles, research, our own notes, and really boil them down to the key insights, basically giving you a shortcut to being properly informed. Today, we're jumping into the Indian stock market. Specifically, we're going to unpack the trading session from today, August 19th, 2025. Yeah, our mission is to give you a really solid, factual, data-backed commentary, useful whether you're a retail investor or a high net worth individual, basically a large private investor. And the idea is to help you get ready for tomorrow, August 20th, with a bit more clarity. So we'll look at the big economic picture first, then zoom into some stocks that were moving, and finally touch on some key analytical tools. Okay, let's get into it. Let's kick off with the broader market. So today, August 19th, both the Sensex and Nifty actually finished higher, extending their gains. That's positive, right? Yeah. But what's really interesting is the why behind it, the economic stuff.
Absolutely. There are a few things going on here. First up, macroeconomics. India's annual consumer price inflation, well, it dropped quite a bit in July 2025, fell to 1.55%.
Wow, 1.55%. That's down from, what, about 2.1% in June?
Exactly. And that 1.55% is well below the Reserve Bank of India's comfort zone.
Yeah.
Their tolerance band of 2% to 6%. So what's fascinating here is that this really strengthens the case, the expectation that the RBI might actually deliver another interest rate cut later this year.
And that drop was mostly food prices, you said?
Yeah, largely driven by a big fall in food prices. Vegetables, in particular, plunged almost 21%. So for you, the investor, while a potential rate cut usually means lower borrowing costs for companies, that could potentially boost their earnings down the line and make those growth stocks look a bit more attractive.
Okay, so that domestic inflation number is a pretty big deal. What about globally? Are there international factors playing into the Indian market right now?
Yeah, definitely. On the global front, everyone's really focused on Fed Chair Jerome Powell's speech coming up in Wyoming later this week. The market's currently pricing in an 84% chance of a 25 basis point rate cut by the U.S. Central Bank in September.
84%. That's pretty high conviction.
It is. And if that expectation holds, well, it can influence global sentiment, maybe push more capital towards emerging markets like India, which could support further gains here. Of course, if Powell signals something different, we could see some volatility pick up. So it's definitely one to watch.
Right. Makes sense. Keep an eye on Powell. Now, beyond the pure economics, sometimes those geopolitical whispers can matter too, right? Anything interesting on that front today?
Indeed. There was a bilateral meeting today with India's External Affairs Minister S. Jaishankar, and apparently China gave assurances about supplying things like fertilizers, rare earths, and even tunnel boring machines.
Interesting mix.
Yeah. Now look, these kinds of diplomatic developments, they probably won't move the market tomorrow morning. But they can influence, longer-term trade vibes and maybe investor confidence, like better access to fertilizers could eventually help the agri sector, or more rare earths might impact tech manufacturing down the road. It's about those deeper, longer-term ripples.
Got it. So macro factors, global cues, even a bit of geopolitics shaping the background. Okay, let's shift gears a bit. When we talk about stocks moving day to day, two words always pop up. Volume and volatility. They get thrown around a lot. But what do they actually mean for you, the investor, in practical terms?
Yeah, good question. Let's break it down. Volatility first. It's not just about how much a stock price has moved in the past. That's historical volatility. What's often more crucial for traders, especially options traders, is implied volatility. This is forward-looking. It's actually derived from the current price of options on that stock.
Okay, so it's what the market thinks will happen in the future.
Exactly. It reflects the market's expectation of future price swings, and it directly impacts the premium you pay for an options contract. So if implied volatility goes up, the option price generally goes up too. Why? Because there's a higher perceived chance of a big price move, meaning a higher chance the option could end up valuable or in the money.
Ah, I see. So even if I'm not trading options myself, a big spike in something like the India VIX, the overall market volatility index, that's like a warning signal.
Precisely. It can signal broader market nervousness, potential swings in equities generally. It's a measure of fear or uncertainty, essentially.
Okay, that clarifies implied volatility nicely. And volume, how does that connect to liquidity? Everyone says liquidity is crucial.
Absolutely. Volume is fundamental to liquidity. Think about intraday trading, for example. You need stocks with high liquidity and significant trading volume.
Why specifically for intraday?
because you need to get in and out of your position quickly, maybe multiple times a day, without your own buying or selling significantly moving the price against you. High volume usually means lots of buyers and sellers are present. We measure liquidity in a few ways, like trading frequency, turnover. There's also something called impact cost.
Impact cost.
Yeah, it's basically the cost you incur to get your trade done compared to the ideal price if your trade had zero impact. A lower impact cost means better liquidity. Your trade isn't moving the market much. And then there's the simpler one, the bid-ask spread. That's just the difference between the highest price someone is willing to pay the bid and the lowest price someone is willing to sell the ask.
Right, like the gap you have to cross to make a trade happen immediately.
Exactly. It's essentially the transaction cost for a small trade. If the best bid is 3 rupees 50 paise and the best ask is 4 rupees, the spread is 50 paise. You want that spread to be tight, narrow for easier and cheaper trading.
Okay, so understanding these concepts implied volatility hinting at future expectations, volume and liquidity, showing how easily we can actually trade. That gives us a much better framework.
Yeah.
So with that foundation, let's look at how these things played out in some specific stocks that were active today, August 19th. What could we learn from their performance for tomorrow?
Definitely. Performances were quite varied today. Let's pick out a couple that really illustrate different dynamics. First, maybe Dhampur Bioorganics Limited. Now, it closed pretty flat today, just fractionally down at 91.58. But its longer-term run is impressive, up almost 179% since April 1st. Wow, 179% is huge. It is. But here's the key data point for today. The volume was 1.32 lakh shares. That's 132,000 shares. And importantly, almost 57% of that was delivery volume.
Okay, delivery volume
Meaning people bought the shares and are actually taking delivery to hold them in their accounts, not just trading them back and forth within the day. So for you, the listener, this high delivery percentage, well, it often indicates stronger conviction from longer-term investors. It suggests people are buying to hold, based perhaps on fundamentals.
So not just short-term noise, potentially a sign of underlying strength or belief in the company. Makes sense.
Right. It suggests it might be worth looking into its fundamentals if you're thinking longer term.
Okay, that's a great example of delivery volume telling a story. What about a contrasting picture, something maybe showing more short-term action?
Okay, for contrast, let's look at Elena Electronics Limited. It finished today at 182.94, up about 1.25% from the last couple of sessions, and actually up for 5 days straight now. It's done well since April 1st, too, up over 43%.
So it's pretty positive, too.
It does on the surface. But here's the crucial bit. Today's delivery volume was 0%. 0%. All 39,000 shares that traded today were bought and sold within the same day. No one took delivery to hold overnight.
Here, so completely intraday churning.
Exactly. So for you, this is a really critical insight. It signals that this stock's movement, at least today, was likely driven purely by short-term speculation and momentum trading rather than long-term investment decisions. Now, it shows strong short-term momentum, clearly, but you need to be aware that this kind of activity can reverse very quickly. Probably not one for the faint-hearted unless you're a seasoned intraday trader.
That's a really stark contrast. And it really highlights why just looking at the price change isn't enough. You have to dig into the volume and delivery data, too.
Yeah.
So our sources give us this great data on today's performance for lots of stocks, but as we noted, they don't give predictive price targets for tomorrow.
That's right. No crystal balls here.
No. But these examples, like Dhampur and Elenen, they definitely show the kind of activity and data points that makes certain stocks worth watching as you plan your own strategy for tomorrow, August 20th. Understanding why they moved.
Okay, so putting it all together, the macro picture, the volume, the volatility, these specific stock examples. What does this all mean for your decisions tomorrow and beyond? How can you actually use these insights?
Well, a really crucial tool for both retail investors and HNIs is technical analysis, and specifically understanding support and resistance levels and also market trends.
Okay, support and resistance. Can you break those down simply? Sure. Think of support levels as price points below where the stock is currently trading. These are levels where, historically, buying interest has tended to emerge and maybe push the price back up. It's like a floor the price struggles to fall through. And resistance levels are the opposite. They're price points above the current price where selling interest tends to come in, potentially stopping the price from rising further or even pushing it back down, like a ceiling.
A floor and a ceiling. Got it. How do you spot them on a chart?
You look for what traders call price action zones. These are points where the price visibly hesitated, stalled, or reversed direction sharply in the past. Ideally, you want to find at least 3 such points, reasonably spaced out, that you can connect with a horizontal line. But remember, S&R isn't usually a single precise price point. It's more of a zone. There's always a bit of a approximation involved.
It's not an exact science.
No. And they can switch roles, too. If a price breaks decisively above a resistance level, that old resistance level can often turn into a new support level on any subsequent pullback, and vice versa if support breaks. They're dynamic.
Okay, understanding those potential turning points sounds really useful. How do they fit in with market trends?
Trends give you the context, the direction of travel. An uptrend is pretty clear. You see a pattern of higher peaks and higher troughs. It shows buyers are consistently in control over time. A downtrend is the reverse, lower peaks and lower troughs, showing sellers are dominant. And then you have a sideways trend, where the price is just bouncing between a defined support and resistance level, no clear overall direction.
So knowing the trend helps you decide which way to lean.
Exactly. For example, if you're an options trader and the underlying stock is clearly in an uptrend, you might favor bullish strategies, like buying call options or selling put options. If it's in a downtrend, you'd look at bearish strategies, buying puts or selling calls. And if it's stuck in a sideways range, well, there are strategies designed for that too, like condors or straddles, which can profit if the stock stays within a certain price band.
And things like moving averages help confirm these trends.
Yeah, moving averages are a common tool to smooth out price action and help identify the trend. Faster moving averages react quicker to price changes, which can signal reversals earlier, but they might also give you more false signals along the way. Slower averages are smoother but lag more.
Okay. Now, just quickly, we often hear about small caps, smaller companies. What's the deal with them in this context? Are they different?
Small cap stocks are definitely an interesting area. They often offer, really high growth potential because they might be creating new markets or disrupting existing ones. And historically, they have actually tended to deliver slightly higher returns than large cap stocks over the very long run, maybe by 2–3% per year on average, which compounded is significant.
But there's a catch, presumably.
Oh, yeah. The catch is usually higher volatility. Their prices can swing much more dramatically. They also carry higher market risk generally, and their financials might be less stable than the big blue chips. So more potential reward, but definitely more risk. And that really brings up a crucial point. Whether you're a retail investor or an HNI, understanding all these concepts is really vital. It doesn't matter if you're trying intraday trading, looking for those quick moves, like maybe an Elon Electronics today. Or if you're a long-term investor looking for conviction, maybe like the delivery volume suggested in Dampor Bioorganics. You need to combine that understanding of the macro stuff, inflation, interest rates, with these technical tools like S&R, trends, volume analysis. And of course, always apply disciplined risk management and diversification. It's about building your own informed approach, not just following tips.
That's a great summary. So this deep dive into the Indian market for August 19th, 2025, hopefully, it's giving you a clearer view of today's action. We went from that surprising inflation number all the way to specific stock stories told through volume data. And we unpacked some essential tools like implied volatility, liquidity measures, and those key support and resistance levels.
Yeah, and if we just connect it all back one last time, the market really is this complex, dynamic system. You've got global events, domestic policy, company specifics, investor psychology, all mixing together. It really requires constant learning, critical thinking, and being ready to adjust your views. So the really important question for you, the listener, is always going to be, how are you going to put these different pieces of information together? How will you synthesize them to inform your own strategy for the trading sessions ahead?
A perfect thought to end on. Until next time, keep digging deeper.